What's up, y'all? Sorry, my son just came in the room and to see what the heck he wanted. What's going on, everybody? Stocks on the rocks.
Hey, Corey.
I don't think what's up, man? How you doing? That's Mike, right? Who said that?
That's me, yes.
What up? You know, I had all these songs queued up that are drinking songs, since this is Stocks on the Rocks. I have all these drinking songs queued up, and I never realized how long this George Thorogood song was. It's 8 freaking minutes. I had 3 other songs I could have played. But oh well, here we are. What's up,
All
Liz?
good.
How are you? Let me see chat box here. I'm gonna get the chat box open,
I'm
and
good, thanks. Sorry, I was on mute.
it's all good. It's all good. I could read lips pretty well.
Sorry, I was going to join your session today, and I spent close to 3 hours on the phone with TradeStation.
Oh, what was going on there?
Well, it turns out it was a problem that actually other people are having, but the guy didn't tell me that in the beginning because it's only just, I guess, coming to light. But it was all to do with their charts was screwed up between, if you do like customized sessions with, you specify, what time frames you want your charts to pick up the candles for, it was giving erroneous results. And it just suddenly started happening in the middle of yesterday. And the guy thought, maybe I had a corrupted TradeStation. We did all sorts of troubleshooting. We ended up uninstalling, reinstalling. And then he kept saying, this doesn't make any sense.
Ugh.
And then he said, hold on a minute, let me talk to some other people. And then he's like, yeah, actually, you're not the first person to report this. So anyhow.
You're like, thanks.
Well, I mean, I think it's a very recent issue, but they've got to try to get to the bottom of it. I don't know if it's just, I think it may depend on what server you're on, because I've got 2 separate logins for TradeStation, and on one login it was working absolutely fine, and the other one it wasn't, which didn't make sense to me. So it's either computer related or it's server related. But anyway,
sounds like server related if other people are having the same issue. I even had some weird in Thinkorswim this morning.
I don't know, but it was I was just knee deep in this, more like neck deep in this conversation with him when your session started. It's like, I'm just going to have to carry on trying to get to the bottom of this.
Yeah, that's more important. If you miss something, you could always go back and watch the recordings, but you got to get your TradeStation. You got to get your platform working again.
Yeah.
So hopefully they got that sorted out.
Well, I'm not sure, but at least he's taken some details and they're going to call me if they need more info. But I mean, I took screenshots of this, that, and the other and sent it all to them. So we'll see.
Well, good luck with that. I know that's frustrating. Been there.
Mm-hmm.
All right. So here we are. Let everybody, almost everybody's in from the waiting room. But here we go. So welcome everybody to our Stocks on the Rocks. This is our every other week sort of open Q&A, happy hour, pour a drink. It's 5 o'clock where I am. It's 8 o'clock where you are if you're on the East Coast, and somewhere in between. David, first time here. Nice to see you, David. Welcome. And yeah, we already got some good questions coming into the chat box, so I'm going to address those right out of the gate. I stopped sharing my screen in case anybody wanted to share their screen with their first question. So I'll share mine back for this, but just know that if there's something that you have going on that you want to share, as far as like a trade you're looking at, a trade that you were in. Hold on, I got to turn my AC up here a little bit. It's ice cold up in here. Trade you want to share, trade you want to look at, a win, something that went wrong. You have questions, what's going on? Let me know. We could swap screen sharing. I will ask, because this is technically open to the public, that we remain PG-13, right? At most, right? We've had some issues opening things like this up to the public in the past, and we've had some not so pleasant people try to come in and ruin it for everybody. So, but I think you guys are all adults here, so let's act like it. But jumping right into the questions here. The first one came from Thomasina. What's up, Thomasina? Nice to see you. Hello, everyone. Her question is, my only question for the evening is there any benefits to having multiple platforms? And the short answer to that would be, well, yes, if you're trading multiple asset classes, has got to be the first thing in my mind, right? So for instance, you got Thinkorswim here. This is a Schwab product. And Schwab, much like TradeStation, much like Tradier, you can trade options and stocks and futures all on one platform. But there are things on Schwab that would make me not want to trade futures with Schwab, even though it's possible. Now, I don't trade futures regularly enough, hardly at all these days, in order to have a second futures broker account. But one of the big reasons is the margin requirements for futures at Schwab are all the intraday margins, which should be, maybe as low as $500, $1,500, maybe $2,000 for say an S&P contract. Those are your intraday margin requirements. They jumped to 23, almost 24,000 overnight in the Globex market. So there's a big jump in margin overnight at most futures brokers. But with Thinkorswim at Schwab, they charge you overnight margin rates, overnight maintenance, even intraday. So to trade an S&P mini contract in the middle of the day at Schwab, it's 23 grand just to maintain that position. Where I would not really want to, I'd want to get more leverage than that. I want to get a better use of capital. So if I'm trading futures regularly, I'll have a futures broker that specializes in that so I can get better margin rates. That's one big reason. And that's really about the only reason that I can think of off the top of my head would be if you're trading options, you're trading futures, you're trading Forex, you're trading cryptocurrency, you may have 3 or 4 different platforms that you're operating on so that you get the best leverage, the best tool for the job. And that would be, in my mind, the only reason to have separate brokerage accounts. I guess another reason could be is the insurance amounts, right? The SIPC insurance amounts could be a good reason. So if you've reached I only have, I think it's 500,000 for SIPC and brokerage accounts, 250 for banks. If you want to spread your money out that way, so that your money is more well insured in the event that that broker becomes insolvent, that would be a reason, right? Not sure.
Corey, is that insurance per brokerage or per account?
I don't know the answer to that. I probably should, but I've never had to use it, so I've never gone down that rabbit hole. I thought it was per broker or per.
Yeah, I have no idea. That's why I'm asking the question. I
Yeah,
really don't know.
yeah. I'd have to probably, Google that or ChatGPT that to know for sure, but I thought it was per bank, not per bank account. So I'm pretty sure it's per broker, not per brokerage account. But I could be
Okay.
wrong. I will double check on that. But yeah, that would be the reason.
I'll see if I can take a look right now on this
Oh,
separate
awesome,
device.
Liz.
I have it. Yeah.
Yeah, thank you. Thank you. Thank you. And then Joe asks, Thomasina has, and do you have any thoughts on Tasty Trade? I don't really because I haven't used them personally. I think they have the same issue that I would have with like a Tradier and TradeStation and Tasty. I think they do not support closing bracket orders on option spreads. That's a big one for me, right? You can set OCO bracket orders on single leg options and on stocks, but when you get into spread trading, which is what I'm mostly doing is spread trading, those brokerage accounts, including Tasty Trade, I believe, do not support closing orders as a bracket order. So you can have a stop and a target working on your trade. I think you can do one or the other, but not both even at Tasty Trade, Tradier, and TradeStation. So Thinkorswim allows for both closing orders. So you can have a stop and a target waiting and then be more hands-off on the exit. Otherwise, I'd be open to using a Tasty Trade, or I'd probably be more open to using Tradier because they have zero commissions for option trades. And I think it's like $10 a month or $15 a month you have to pay as a subscription to actually get no commission option trades. I'd actually investigated moving the hedge fund over there, but I don't think they offer they don't offer the type of reporting that our administrator needs to compile investor reports and all that kind of stuff at the end of the month and at the end of the year. And the audit is, I don't think they're not set up for hedge funds as much as Interactive Brokers is. But otherwise, like I have an Interactive Brokers account, but that's for the fund. And the only reason I have that is because of all the reporting mechanisms. It's set up for hedge funds. And Schwab doesn't allow hedge funds. So those are a couple reasons.
Okay, I've got an
Okay.
answer for you, Corey.
What do you got? What's the answer, Liz?
So it is per account, but when I probed it a bit further, it came back and said the SIPC coverage applies per separate capacity. So, for example, individual brokerage account is one separate capacity. A joint account with a spouse would be another capacity. A traditional IRA or a Roth IRA. So as long as you've got sort of different buckets, as it were.
So if I had two traditional IRAs,
Yeah, I don't think that's going to
that
help
probably
you.
would be considered one capacity.
One, I think that's right from what I'm seeing here.
That
like
makes sense.
A trust account would be a separate 500,000
Right.
coverage.
That
Or
makes
a corporate
sense.
account.
Yeah.
But two
And that's
individual
good to-
accounts in your name, no, they're
Probably not.
combined.
That makes sense. And I'm trying to think right now. I have one individual, one traditional IRA, one Roth IRA. Yeah. And then all the other accounts that I manage under are all different types of accounts also. So that's good to know. Thank you for
Yeah. Okay, no worries.
doing that.
I did not know that either, but that's good to know.
Hey, listen, I don't claim to know all the answers, but that's what the interweb is for.
Oh, I love AI. I use it all the time.
Yeah, man, I'm telling you, I love it. Okay, so Joe's next. He says, "What's up, Joe? By the way, can you explain EMAs? They're actually, and you put estimated moving averages. They're actually called exponential moving averages. So EMA is an exponential moving average, and how that differs from a simple moving average. That's very easy. And I'm going to plot them both on the chart here. So I've got this chart up, BX, for no other reason than somebody was having me look at it a little bit earlier. So, but this will be a good example. So a simple moving average, for instance, I've got a 20 and a 50 period moving average. The blue line is the 20, the red is the 50. And a simple moving average, the way it calculates its data point is it takes, for instance, the last 20 closing days, because I'm on a daily chart. If this were a 5-minute chart, it would take the last 25-minute bars. But in this case, it's a daily, so it takes the last 20 days and it takes the closing price for every day. Closing price every day for the last 20, and it adds all the closing prices up so you get one big number, one big total, and then you divide that by 20, and that is a simple moving average where it shows that it's simple because it's just dividing equally over the last 20 bars. The 50 period moving average would divide equally over the last 50 bars after adding the last 50 closing prices up. And after today's close, it would basically imagine this. Imagine it puts another dot on the chart here. And if the average closing price is getting higher, it'll take the existing line and it'll just connect it. And that's how it's aligned. But it's simple because it's expressed equally over 20 or 50 days. Now, an exponential moving average, I'm going to add one of those. Exponential, move average exponential. And I'm going to make it a 20 bar also. And I'll actually add two. I'll add a 20 and a 50, just so you can see the difference between the two. Why is it not adding another one? There it is. Just was not listening to me very well. So 20. Now I'm going to make that one green. And the 50, I want to make it a different color than all of them. Let's make it purple. Okay. So now apply it and add it. And what you'll notice, not know, but notice, is you see how the green line here, which is my 9-period moving average, how it's getting out in front of the 20-period moving average. It's actually accelerating faster than the 20. Okay. And this one is not accelerating just yet because it's a longer period of time. But essentially what happens is the exponential puts more weight on, it doesn't put equal weight over 20 days. It puts more weight on the more current days. So an exponential moving average is more sensitive to what price is doing more recently versus what it's been doing equally over the last 20 days. That's it. That's the only difference. So an exponential moving average is going to be more responsive to what's going on more recently. Another way to say that. And then Ian was so kind to put a math formula on, which up here in the chat box. So what I'm going to do is I'm going to get a calculator out and we're going to go through this formula using it on BX one day at a time. And and that's a joke. I'm not doing that. If anybody was concerned that I was actually going to do that. But yes, that is it. So thank you, Ian. Average price over a specified number of periods, average price placing greater weight on the most recent time periods. There it is. Yeah, Ian, we're not doing that. Make sense, Joe? And then David, question day. What is your ideal spread trade nowadays? I am almost 100% of the time, not quite, but almost 100% of the time using some form of a vertical spread, which is different strikes, same expiration, right? I like to minimize exposure to theta and vega while maintaining delta. And so I'm really just focused on if it's a debit spread, is price going to move without the negative effects possibly of the other Greeks, and just worried about delta. And if it's a credit spread, again, I'm still doing a vertical spread. I'm buying insurance against the one that I'm selling, and I'm only concerned about that window of time, so I don't need to really use different expirations. If I'm going to explore any other type of spread trade, that would generally be maybe a back ratio spread, but that's a very hyper-specific environment that I would use a back ratio spread for, which is extremely low volatility now, but I expect a breakout move in the stock and ideally a large increase in implied volatility, because that's a very negative theta, negative vega type trade. Or positive vega type trade, not negative. Negative theta, positive vega. And so I'm most of the time using vertical spreads. Occasionally I'll throw in a call ratio back spread or put ratio back spread. Never a calendar spread unless it's diagonalized. And even then I don't do those very often. I keep it simple and I go vertical spreads most of the time. Got some more folks coming in the waiting room. Let's see. Oh, and then Joe asked the question. Good question, because I saved some stuff. So I don't think you were in last week. I couldn't find anybody personally that has a lot of VWAP experience. However, somebody last week did talk to Scott Marjolano, Scott M. Marjolano. I always murder his last name, and he gave me count them, two links. I'm going to paste them in the chat box, where he did webinars and a YouTube video on how he uses VWAP. So the first one he did on his Twitter page, his X page, and the other one is on YouTube. So check out both of those links. And that's about as much as we could find on VWAP. Somebody that we know and trust. Right. I'm sure there's a lot of stuff out there on the web, but somebody that we know and trust, somebody that uses it. So that's the VWAP stuff. So check that stuff out.
His name's Marigolio.
Marigolio.
That's how you say it.
I'm going to get that wrong every time. Marigolio.
It's nothing like it's spelled.
I know.
I have to look it up every single time.
Yeah, yeah. And by the way, the person talking right now is the person who came up. That was Jason, right? Is that you?
Yes.
Yeah, Jason actually got this information for us. So thank you, Jason, for that.
You're welcome. And whoever asked that, he did the lecture that's on the X link especially for us, because I asked him because since you had asked that question a few weeks ago.
So that one's especially for the group here who asked the question. And then the YouTube video, I think you said was a little bit older and it was
Correct.
more for the general population.
Right.
Right. So as a follow-up here, Ken asks, do you find VWAP useful? I don't know because I've never used it. I've never found that I've needed to use it. I think it's, yeah, I don't know. I've never used it. So I don't use a whole ton of indicators. And there's certainly hundreds of them out there. So I'm not sure if I would find it useful or not because I've not really used it and wasn't ever really taught how to use it. Maybe there is something in these videos that, that could inspire us to start using it a little bit more. I don't know. I don't know yet.
Corey, I've traded with a couple of people that use it. I don't, but my observation is it's really only useful for intraday, really short-term trading, which probably doesn't apply to any of us in here in the context of options. So like for intraday futures.
Mm-hmm. I heard the same. Yep.
More as a target than an entry, because and I think when I first heard the question on this stocks on the rocks a couple of weeks ago, whenever it was, I was listening to it on recording and I texted you there and then, and I said, think of it as more of a reversion to the mean.
Mm-hmm.
So I think if people are entering a trade sort of at an extreme from the VWAP, that it's a fairly reasonable target to use. But that's about the extent of my knowledge with it. And again, I just don't believe it's relevant for longer term trading.
Yeah, and I've never even pulled it up, honestly. And if this is VWAP right here, this is it. I can see why Mike would say I found it to be basically a Bollinger Band, but volume weighted Bollinger Band, not based off a 20 period moving average or anything like that. So I could see how that could be useful for targets.
Yeah,
Yeah,
I found it to use it when we're using it as it's a Bollinger Band. You can set it for whatever deviation you want, and
Mm-hmm.
and to Liz's point, it's you can use it long term, short term, but all it is a confirmation that you're reading. For me, it's a confirmation that you're reading the chart right. Are you entering in at a supply or demand zone? And it kind of gives you an idea that you still got
Yeah.
to go off the chart.
I don't know why the daily chart only gives me one line. It doesn't look like that on the hourly chart. It has the bands, but on a daily chart, it doesn't. It just gives me the one line. It doesn't make any sense, but probably because it is only useful for intraday because it only loads on intraday.
Well,
Car,
so
uh,
have you ever seen Chuck? I know in the past has pulled up on Thinkorswim what's it called? So it's going to be like a bar chart on your
market. Yeah, it's market.
y-axis. It's going to
Yeah,
be
like
volume
market
profile.
volume profile. Yeah.
Volume profile. So that's going to show you at each price the amount of volume that's been traded there.
Right.
And the volume weighted average, I think, is just a single number derived from that. So as the day
Would make
evolves,
sense.
your volume weighted average price is going to change during the day. But once the day is completed, the calculation's done. There's nothing further to add to it because it would start
Right.
again with a new
That's
volume.
true. That's true. So it would literally only be useful for anything intraday.
Yes.
You couldn't even use it on a daily or higher,
Well, you
which makes
could, but
sense.
it'd probably be useless. I mean, you could do what you want. I wouldn't
Well,
recommend it.
it's not giving you the outer bands. It's only giving you
No.
volume weight, the
Well,
average, not
I
No, it
guess
would just be for an entry, when you're fine tuning an entry.
yeah. Yeah, and there's
well, I would
yeah,
say more as a target personally. But anyway,
and you would to use it as a target, you would need to use intraday because there was no all it was giving me on the daily was the middle line of the bands, not the outer two.
That was a rabbit hole.
I know, right? But it's good. I like it. Yeah, just because I don't use something doesn't mean it doesn't work. And so I could go down rabbit holes easily and try this indicator, that indicator, and quite frankly, the time to put it in, I haven't felt like I needed to use anything extra, but there might be something there. We'll see. But I don't intraday trade. So to Liz's point, I don't intraday trade, so it probably would not be useful for me anyway. And Carl asks, are you well versed enough in ThinkScript to rewrite the anchored VWAP indicator to use and add a start time and not just a date? No. However, my assistant at ChatGPT and Perplexity, they are well versed in ThinkScript. So if you tell it what you want, it'll write it. Which I've done that a few times and experimented with it. I didn't go very far with it, but it'll do it. It knows how to write ThinkScript. You just got to tell it exactly what you want and it'll write it. Reminds me of quant classes. Yeah, I hear you, Thomasina. So let's see. Can you show us how to scan for gap up or gap down in Thinkorswim? So I don't have a scan for that, but I believe, if I'm not mistaken, you can probably come down to one of their public watch lists and say gap up, gap down. And there's a public watch list that Thinkorswim has. Gap up, gap down. And so I would start there. Now, this doesn't look like, I don't know. Yeah, so I mean, these did gap, but these are all gap. I mean, everything pretty much gaps, right? But no, I don't know what this isn't a scan that I made up, so. There's nothing else in here. Lovers, losers, post-market move, pre-market movers. Pre-market movers would probably be a good one, right? So if pre-market, the stock is down a lot, you know it's going to gap a lot down. If pre-market is up, you know it's going to gap a lot up. So that's probably a better, because the one thing I noticed just looking at the gap is everything gaps a little bit. So what are they considering a gap in this? Almost everything gaps a little bit. So how big of a gap do they have programmed into that public scan? I have no idea. So I'd probably start with, like I said, the lovers and losers, pre-market movers, and that'll get you in the ballpark of anything that's moving before the bell rings. That's probably what I would do if I were looking for gapping stocks.
Yeah, but I've got something that I've set up on TradeStation for gap up and gap down. Obviously, you know, the usual liquidity requirements, and I think my parameters are something like gapping up over 3% or gapping down over 2%. And I run it every morning, and especially during earnings season, it's fantastic because it'll show you the big movers. And if I see like a really well-known name stock that I know has got really liquid options, I'll kind of pull up the chart, see if it's coming into an area of interest, and then I'll watch it at the open. And if it's, you know, sometimes if it's gapping up enormously into a supply zone and you want to catch the volatility crash on a bear call spread or bull put spread, if it's gapping down, then you can get some really great trades. But I find it just generally more useful during earnings season.
Yeah, and I was going to ask, like, I'm looking at the like the stock filters in here. That's my first stop, and I was looking at percent change, and I feel like you could almost build a scan off that, like gappers up, percent change by a certain percentage, or down by a certain percentage. You could probably build one, and then just put at least, you know, like you said, at least 3%, at least 4%, whatever the number is.
Yeah, whatever you want. Yeah, and I mean, presumably,
and that's how you do it, is off percent change, right?
That's how I do it in TradeStation. I mean, I have my usual filters with liquidity and you know, volume and that sort of thing. But then, yeah, I just say percent gap up by at least 3% and gap down by at least 2%, or, you know, however. And I mean, if the markets are like this morning when I ran my gap up, I mean, I had goodness knows how many criteria, how many stocks showed up in the scan, but then I can just sort the results of the scan to show the most extreme.
Right. Yeah, so I think that percent change would probably work. It would be do the same thing. And I also think, Miral, that that Thinkorswim would do the same percent change on the day. It wouldn't be pre-market. So pre-market, you know, this pre-market movers, you probably have to scan through and visually look. So like if you're scanning through and saying, you know, Chow, like if Chow were down pre-market, you probably wouldn't notice it right here. I don't know. I've never looked at it. You might notice it right here, but my guess is you probably wouldn't notice it right here. But you would notice it up here under the bid ask, right? So DRI, right now the bid ask, I mean, it's very closed, but 191.10, 180, 192.84. If you're going down the charts and you're seeing that this bid or ask is way above or way below the close price from yesterday, that's one way to visually see pre-market how much it actually is moving. Look at the bid ask. Doesn't give you a percentage, but it gives you the bid ask pre-market. So I don't know. I don't know. I'm pretty sure it probably wouldn't update this column here, but the scan is using pre-market data to bring that up. And DRI, Darden, had a pretty big jump down today. And Intel probably had one of the highest jump ups today. And some of these will be useless, obviously, because these don't scan for million shares or more on average. I need them to be optionable, things like that. So I'd start with pre-market movers, number one. And then you could also look at it wouldn't take pre-market into account, but it would wait till the market opens and then it would populate, to your point, Liz, it would populate a scan that's anything over whatever percentage you set up or down. It's probably two separate scans. It would populate it, but you got to wait for the open for that, which is generally fine anyway.
Yeah, but on TradeStation, it'll run the scan before the market. It'll tell me what's currently.
Oh, nice.
It'll tell me if the market were to open right now, here's what would be gapping down.
Oh, that's nice.
More than 2%, up more than 3%, whatever you want to change your criteria to. And then I will literally just quickly speed date those charts before the open, look at the ones I may be interested in, and then I can just set some alerts on those and just kind of have those charts visually in front of me at the open so I can see what's happening.
Sure.
I don't have to run a second scan at the open.
Yeah, I'd be curious if this scan would pick up on, or if it on anything pre-market, or if it would pick up on only after the market opens. And I don't know the answer to that because I've never used that percent change in my scan.
So in Thinkorswim, there's no way you can kind of go into the guts of the scan and see what the criteria are then? Is that what I'm concluding?
I don't think so. Like I just changed this to percent change and it asked me for a minimum or a maximum. And I can't see further than that.
Okay.
It just tells me minimum, maximum.
Well, another place you may have more control would be FinViz.
FinViz, Chuck uses a bar chart scan. He
yeah,
uses
that's
bar
true.
chart stuff.
Yeah.
So there might be some other areas there to do it.
Okay.
Right. Okay. What did I miss? So EMAs indicate movement or volatility in more recent time frames. Yes. That is true. Corey, would you mind reviewing candle wick range? Joe, what do you mean by that? Candle wick range. Like just like what do you mean? I'm not exactly sure what you mean by that. I mean, in its simplest form, open, low, high, close. The range is from high to low. And the candle's body is just open and close. Is that what you mean? I'll wait for you to respond there, and I'll look at some other trades that I might have missed. What type of options trades do you generally set up in the options room? A lot of vertical spreads. It also depends upon the room. Like we keep a running spreadsheet of trades. So here's a bunch of trades that we place, in the option trading rooms, for instance. So these are all vertical spreads. Most of these are going to be vertical spreads. Here's an iron condor, which is still vertical spreads. Yeah, most of these are vertical spread. They're all vertical spreads. Long call. Here's one on Ford, long call ratio, back spread. But yeah, they're 99% of the time vertical spreads. Now we have a wealth essentials room, which is more designed for like selling cash secured puts and covered calls and things like that. So that's our wealth essential spreadsheet over here where we track all of our trades. And these are all cash secured puts. So anytime we're selling cash secured puts, that's not covered by anything but the cash in the account. That's not a spread trade. So we map out all the details of all the trades for wealth essentials. And then when they're closed. And then we keep a running total of, monthly profits on those trades. Each trade, how much it made, and then the monthly profits. Sometimes, we have a losing trade and it's in red. These trades don't lose all that often, but we do have some. A lot of green though, which is good. Let's see. Mike says, please review your spread on floor and decor. Gladly. FND, which had a not so great day yesterday. But the spread on floor and decor is at the time of entry, so it's a 29-day, it's an October 17th position. At the time of entry, it was first of all, $2.50 wide spread. So we're selling the 90 puts. So this is a put spread, credit spread, buying the 87.50s. So the worst case scenario risk is we have to buy the shares for 90 and we turn around and sell them for 87.50 if the stock is below 87.50. If the stock is above 90 at expiration, everything expires worthless. And so the goal here was when the stock was trading on this day of entry, it was trading just below 90. I thought, well, I'm thinking that price is going to continue to try and grind its way a little bit higher until we get up to this supply level here that starts on the low end at 95, really more about 96.50. And so I thought, yeah, this thing's probably going to grind a little bit higher. I had no great place to put an out of the money credit spread and not enough profit margin to deal with a very directionally biased spread where I need the stock to move a lot. So when you're at the money and the stock is at 89.60, and that's about where we got in, the stock only needs to go up about 30 or 40 cents and stay up above 90 in order to see this trade through and be profitable. Now, of course, yesterday it shoved it all the way back down to 87.17. So now both options are in the money. And so when you look on a risk profile here, the current price is at 87.11. So if this trade was closed right now and we were expiring today, I would take max loss was $125. If the stock is above 90 today, I don't make very much today, but if it keeps going up, that'd be better. We make more, says the red line. But at expiration, if it's above 90, we make the maximum, $1.25. If it's below 90 or 87.50, lose the maximum. So it's a 1-to-1 reward to risk. And so it really wasn't it was only like a barely mildly directional outlook with the outlook that price was not going to probably zip higher. And if it did, it would run right into the supply a little bit closer. But yeah, I was just looking at this as it doesn't need to go up that much. And I'm basically straddling where the current price was. It's either going to be above 90 or it's not. And that was kind of my outlook. It's either be above 90 or it's not. And I'll take a 1-to-1 risk if that's the case when prices are at the money. Okay. Does that make sense?
Yeah, I was just trying to wrap my head around in the money, close to supply, needs to go up. It's not something I've done.
Yeah, and this is not that in the money. Like if I needed the price to go to 95, in order to see this trade through, I'm not selling something that deep in the money. Right? I'm not going if I need the stock to go to 95 and I'm taking a strongly directional outlook, and let's say it was the 90 by 95, right? If you go 90 by 95 bull call, where you don't have any assignment risk until the stock gets above 95, right? That's going to cost $1.38. But if I were to do 95.90 in the money, now they're after hours prices. So during the market hours, the debit on one plus the credit on the other would equal $5 because that's the spread. Right now, the market's wide, really wide, especially on those 90s. So this is not pricing accurately. But when the market's open, the mid price on the debit spread and the mid price on the credit spread, add them together and they will equal $5. Right? So there's no difference between selling a in the money put spread and buying a call spread that shares the same strike prices. Difference is the short strike in a bull call spread is out of the money, so there's no assignment risk on that. A deep in the money put option, where the stock is at 90, or the short strike is at 95 and the stock is at 87, if we were to open it now, there's more assignment risk on the short put spread than there is on the long call spread. So that's why I wouldn't sell a deep in the money put spread. I'm fairly comfortable. I'm comfortable selling something at the money where price doesn't have to go up all that much. But that's basically all you're talking about here. So if we were at the money today, 87, that we were looking at a similar trade, here's $1.20. Say we got $1.25 for that.
Yeah.
Right? And you're basically saying, okay, well, the stock, in this case, in order for us to receive max profit at expiration, you can see it doesn't need to go up all that much. It just needs to go up and stay up above 87.50. Where normally, if you're saying, I think the stock is going to go up, and you up to 95, let's say, and you buy a 90 by 95 bull call spread, or even let's go at the money, 87.50 by 92.50, right? Here's current price. Look how much more the stock has to go up in order to get max profit.
Okay.
See what I mean? Whereas something that's at the money here, stock doesn't go up, doesn't have to go up that much to get max profit. Now, in both cases, the stock has to be closer to expiration to get max profit. But it's just I don't need the stock to move that much. I just need it to move a little bit, and I'll take the bull put at the money, slightly in the money short strike. But for a bull call spread where I'm being directional, you're going to need a much more aggressive move. So it's just a little massaging of the strike prices to accommodate what I expect from the stock and what I need from the stock to be profitable.
And price action, you looked at it, would be the way it looks is it's going to pop up a little bit more according to your process.
Right. Yeah. If I expect a big aggressive move to the upside, I'm not selling an at the money put spread. I'm going to buy a bull call spread because I'm going to be able to profit more from that move. With an at the money bull put spread where price doesn't really, at that point, price didn't really even need to move at all. I'm happy taking a 1-to-1 if price doesn't have to move at all, or maybe it goes up a little bit. And I did expect it was going to go up a little bit yesterday, and then, it didn't. And then today it came down as finding some support in this area, it looks like. So, it's just a matter of how much do you need the stock to move? How directional do you want to be?
Okay. Thanks for clearing it up.
Does that make sense?
Yeah, it does.
Yeah. Cool. Let's see. Questions. Looks like Corey, any thoughts on trades after this Fed changed in rates? Market waited for months for this decision. It did, and it reacted positively. Overall, I mean, the S&P, just looking at SPX, everything gapped up. I mean, SPX traded back down off its highs to close basically very near where price, opened. It wouldn't surprise me to get a pullback from this area to this 65.50. Wouldn't surprise me there. Just because we've had basically most days, except for yesterday, most days we're running straight up. And specifically, if you look at a weekly, we've got 7 weeks of positive closes. And so, yeah, I mean, just like any, time we've had 7 weeks of positive closes, I would expect some pullback. And I think it's probably more so profit taking than anything else. I mean, but I don't have any very specific, like, oh, look at this stock or look at this sector. I don't trade like that necessarily. I don't look at that, but I did anticipate a cut. I did anticipate a little rally today. As long as we got a, quarter basis cut, I did expect, a continuation of what it tried to do yesterday. Was it tried to rally and then it just kind of whipsawed around the rest of the day. But I did expect more of a rally than not. But we are getting pretty extended, so I kind of feel like there's a lot of people looking to lock in some profits. And something I was looking at earlier today, to try to take advantage of a small pullback would be a very short term. And I think you guys might like this. It's trading for $1.70 at the mid today. But basically, if I'm expecting a pullback on a daily chart to 65.50, and I got a bunch of positive delta in the portfolio, bunch of positive delta, right? How can I offset that? Especially because tomorrow's triple witching, and I know that can create some volatility. But also something that Chuck pointed out, which I didn't verify, but Chuck's a smart guy. He doesn't just throw stuff out without, having some sense of it being true. He said that historically, the week after triple witching is usually a down week. Oftentimes is more downward volatility, which, I don't know what sense that makes fundamentally, but if that's true, and I also expect to pull back from a 7-week rally to the upside, and kind of shaking off some of the, some of what happened this week with interest rates and locking in some profits. I said, well, what if price gets back down to 65.50? And earlier in the day, this was trading for $1.50. I might not be so opposed to getting in some. Oh, is it quadruple witching tomorrow? Quadruple witching. Your little book says. A quadruple tomorrow? I guess it would be.
Yeah, because the indices.
Yeah, because we have the
expiring as
index.
well.
Yeah, we have the quarterlies expiring tomorrow too. Can't believe it's September already. So yeah, that would be quadruple witching. So I mean, it's not 2-to-1, profit margin here. But by the end of next week, if we're down here at 650, $150, or in this case, $170 investment could turn an $830 profit if all next week price makes its way back down to this 65.50 area. So it's super counter trend, not something I would put a ton of money in, but just looking to take advantage of a short-term pullback in the context of an uptrend, not spend a lot of money, be willing to risk it all, right? So whatever you pay, and the risk reward out to next Friday is fantastic. Right. So I do expect it will probably end up getting a little pullback next week.
Yeah, so a couple of things that just spring to mind. One, I believe that all 4 indices made a brand new all-time high today, which in itself has got to be very positive for the broader market. So, not like it's just the Mag 7 that are all-time highs. It's like across the board.
Right. Yeah. Russell, the all-time high that it traded to was 2466.49, 2470.08. It actually closed in all-time highs. Definitely the Qs did, definitely the Dow did, and definitely the S&P did. So we were just waiting on the Russell.
Right. So that in itself is really positive. But then to your point, that probably leads to a strong likelihood of a bit of profit taking. The second thing I was going to say is September seasonally is the worst month of the year. And I think if you look at how the seasonality plays out, typically the first half of the month is not so bad. And then it's the latter part of the month that accounts for the the downward slide
The downward.
historically.
Yeah.
But then also I heard some statistics today that I haven't sort of verified independently, that in months where September has closed positive, like bucking the trend of seasonality, then I think it was something like in all instances since it's happened, since, I don't know, whenever mankind was first created, I don't know when, the S&P has continued, has rallied for, no, what was it? Was it the next through the end of the year and 12 months following, it's all been positive, I think is what I heard.
Interesting.
So I think the overall market is really bullish, but not to say we're not going to get some pullbacks, whether it's profit taking or just, you know, vibrations of some other kind.
Right. Yeah, and this is a seasonality chart on the SPX, which is clearly bucking the trend. The
Yes.
black line is normal for September. And
We're
then,
up something insane, some insane percentage for the month we're up so far. And I forget what it is, like 5%, 6%, 7%. I don't know what it is.
yeah, there's a
It's a lot.
huge divergence. There's a huge divergence between what's normal and what's actually happening. Right.
Exactly.
So that's why, I mean, you can only put so much weight on seasonality charts and the stock trader almanac and things like that. I mean, current news environments and current, you know, economic activity and all that kind of stuff will trump everything. But yeah, I mean, we are certainly from August and September, we'll see what November has in, I'm sorry, October has in store. October is usually kind of flat. You know, it looks like here. September is usually bad. And then certainly, you know, back here, February, March historically has been not great. And it was not great, but that was worse than most because of the introduction of the tariff conversation. Mike, what is this chart telling me? Well, the black line goes back, and I didn't create this chart. So the black line goes back and it looks at historically.
No,
I'm
no,
sorry.
I was just saying, I hear opinions that's like, well, what's the chart telling me?
Oh, gotcha.
Where's the
I thought you were asking,
opportunities
what is
at?
this chart? Yeah.
I just see opportunities go up, go down, give me an opportunity.
Yeah.
Mm-hmm.
And you know, it's just sort of like, you know, everybody has their own opinion about where the market's going to go. And sometimes, you know, even mine and Chuck's opinion or mine and Liz's or Liz and Mike's and whoever, everybody will have a different opinion. And so I've gotten to the point now where it's just like, well, it looks like it's going to do this. And I'll say, maybe, maybe,
Does the
you
chart
know,
go up? Maybe. Chart
you
can
know,
go down?
maybe,
Maybe.
you know,
What's the chart telling me? Where's supply, where's demand?
yeah, I'll tell you, I'm not taking a strong bearish bias, but I don't mind having some hedges on just in case. You know what I mean?
Yeah.
Well, it's
Makes
that old mantra, isn't it? The trend is your friend till the bend at the end. And until we get the bend at the end, just keep going.
Keep going with the
Keep riding
occasional
it up.
negative, yeah, with the occasional negative delta, you know.
Keep moving your stops up. And at some point, yes, we probably will get a giant cascade, but
Oh, I hope
Yeah.
so.
until we see it. I mean, and usually, and Chuck talks about this a lot on his Tuesday morning sessions, you know, when you get a major pullback, you get warning signs of it. It's not something that just happens overnight.
No,
The
no,
chart
unless
will
it's a
tell you.
9/11. 9/11 was overnight, right?
Well,
That's a very
okay.
extreme circumstance, but you're right. You always get warning signs.
Okay. All right. Fair enough. But
Yeah, you know, war breaks out overnight, terror attack breaks out overnight. Those are so few and far between, luckily, but there's always signs. It's always warning signs. And right now, I just don't see any signs. Now, some of the negative delta that I've been building into the portfolio that I'm trying to find more opportunities to do so. We did one, I'll give you a kind of peek behind one of our trades in the hedge fund, which was we were short the 219 puts in IWM. Right, short the 219 puts. And I'll get you exact data points here. I think you'll like this. This is something we talk about in the trading room. We've been talking about it more frequently now. So IWM, we're short the two. Can you guys see this font size okay? I know it's kind of small, but So 219 were the puts. We got 456 for those, 23 contracts. And while we did collect something like an almost a $10,000 credit on that, we weren't going for the full 10,000. We were just going for what we're trying to make in the month of October based upon when we actually placed this trade. So we were looking to make about $4,000 on this trade and then close it. So basically open it for 456 and close it for 282 and keep the difference. And so what we did is instead of closing the 219s for a profit of $4,500, what we did is we actually did what we call a free roll. So what does that mean? So the free roll, and I love this idea, I'm loving more of it. I want more opportunities, and that's what I'm looking for more frequently now, is the December 219s. We sold them for, what did I say, 480, 458, 486, something like that. What did we sell them for? 456. Right? 23 contracts. I'll build the exact position. And then, so here's what the position looks like. And by simply buying those options back, analyze opposite trade, we would have closed them for, I think we were trying to close them for like maybe 262, right? So we end up with a $4,500 profit there. Okay. But instead, we kept the short put on and we looked at what are the 220 puts trading for, right? What are the 220 puts trading for? And so by purchasing the 220s for 282, we gave up an extra 20 cents because we were trying to close the position for 262, but instead of closing it, we paid 282, which is the same thing as paying 262 plus 20 more cents. But what did we get for paying 20 more cents? Is we now own the 220 by 219 bear put spread. So instead of closing it for no future potential profit, we flipped this trade, guaranteed a $4,000 profit because we gave up an extra 20 cents. So we gave up, $400 or $500 there. But what we have now is a bear put spread that profits upwards of, we locked in 44,000, so we can make an extra 2,300 if IWM drops back below 220 by December 2018. Sorry, but by December 19, 2025. So what we basically got here is we got free negative delta. We were only in the trade. You'll see I got it over here. We were only in the trade for 14 days. Haven't built that one out yet. Only in the trade for 14 days, and now we have 92 days of free negative delta on the index. So I like the idea of, instead of closing puts, short puts for a certain profit potential, can we, what I call a free roll, and get negative delta for the remaining time in the trade? And it's free negative delta. So it's not just removing positive delta from the portfolio as prices go up, it's removing positive delta and flipping it to negative delta. So it's not costing you to start automatically hedging your portfolio. And I like that idea, especially when there's 92 days left.
Where are you
Right.
teaching this at?
I'm sorry?
Where are you teaching this at?
In my trading rooms. This is where
your platform.
Yeah. In our trading rooms each week. So I talk about it a lot more when we're selling put options as a wealth essentials investor, like I showed you this portfolio earlier. But where I'm teaching that is, I teach, this is how like anytime we come up with something new, and this came out of us looking for hedging opportunities in the hedge fund, and we found this to be an effective way to add negative delta to the portfolio without actually really having to pay for it. And so anytime we find something new that we find works really well, I'm going to introduce it into the community as well. So I don't have a class around it. We just introduce new things in live conversation 2 days a week in options, and then 1 day every other week in wealth essentials. And that's just options. We have 4 or 5 futures trading rooms each week as well. But I introduced this stuff in the options rooms, which is fun. Options give you options, and there's so many things that you can do with them. I would never claim to know all the things you can do, but when I stumble upon something that's actually pretty cool that, I'm like, no one's teaching that stuff. Right? So I've never heard anybody ever say anything like what I just said before. So I'm like, that's pretty special. I'm going to lean into that more. Right? All right, Tomasina, nice to see you. Catch you in a couple weeks. We're going to take off here in a second. It's the top of the hour, and I can't go too much over because my son and I are going to see Nine Inch Nails tonight. So, rock concert night.
Nice. Well, go enjoy yourself.
Yeah.
Thanks, Corey. Appreciate it.
My pleasure.
This is fun again.
Oh, it's always fun.
Corey,
Maria's loving this. She's sucking this up like she's soaking up like a sponge.
I love it. Keep going. What's up, Liz?
Corey, I was just going to say, talking of concerts reminded me, this week is Louder Than Life, and you would not believe it's just like unbroken sunshine. We have not had rain in weeks here.
Of course.
It is gorgeous.
Of course.
Sorry, I just had to tell you that.
Of course, because last time she's referring to my son, who's in a band, played Louder Than Life festival last year, and we were there, and it rained the whole time, and almost like canceled the entire festival. And they canceled the day that my kid was supposed to play, and luckily they were able to get on the next day at a better time slot. That was when a hurricane was breaking up. That was the hurricane. That was the hurricane breaking up, coming up into that area, right?
Yeah, no, that does sound right. I remember it was absolutely horrendous weather. There was no way they could have played outside.
Come to Rockville in Daytona Beach.
I almost went to Rockville this year. But
Blistering
yeah,
heat. They give away water for free. It was great.
that's great. Yeah. They didn't play Rockville. They played Louder Than Life and they played Aftershock. They didn't play Rockville, but I will only go to festivals if I have an artist pass. Let's put it that way at this point. I've experienced artist pass and being able to go back in the trailer and artist lounges and being able to get away from the crowd and watch bands from the side. I just assumed
you were doing that already.
No. I don't have those kind of privileges.
I led a spoiled life. So with brother being the professional, I was backstage on everything.
I know. Yeah. Now my son is, and anytime he can get us back there, he will. One of our good friends plays drums for Nine Inch Nails, and I'm not even going to bother asking him because he only gets like 2 passes a show.
Yeah.
And his mom and I think cousin are going tonight, and his brother and his nephew are going tomorrow night. So my son and I bought tickets to this one, and
awesome.
maybe he can swing a little something, get us on the floor because we're in seats, but our seats aren't too bad.
Go make memories, man. Have a blast.
We'll see. It's supposed to be a hell of a production on this tour. So, and I haven't seen Nine Inch Nails since, gosh, it's been 20 years.
Yeah, date yourself.
At least 25 years since I've seen Nine Inch Nails. I've seen a handful of times, but yeah, I'm excited for this show tonight. So
go enjoy.
Yep.
Thanks, guys. Liz, good to see you again.
Thank you.
Yeah, you too. Thanks, guys. Thanks, Corey.
All right, you guys, enjoy your evening, and I will see you guys in Monday's trading room for sure for options. If you are not a member and you are looking to become a member, I'll put in a promo code called Trader60, Trader60. It'll take 60% off your first month. And if you want to check it out, come hang out with us in the trading room, see if you like it or not. That'll give you 60% off your first month. That is the only shameless plug I will do about becoming a member. But if you're not and you want to check it out, there it is, Trader60. Other than that, you guys enjoy your weekend.
Yep, you too.
All right, see you guys in a couple of weeks for Stocks on the Rocks, and I'll see the rest of you pro members in trading rooms next week. Be good, y'all.
Good night.